For the first time in modern American history, we're seeing something that should terrify every person watching this video. 3 separate data points just crossed lines that have never been crossed before. And when I show you what BlackRock quietly did with 58,000 homes last month, you'll understand why 73% of Americans are now mathematically locked out of homeownership forever. We're going to walk you through the most shocking housing data we've seen in our 15 years analyzing real estate markets. By the end of this video, you'll know exactly why your neighbors who bought houses 5 years ago gained more wealth than most people make in a decade, while everyone else got left behind. And we'll reveal the one metric that tells us this isn't temporary, it's permanent. But first, let me show you a chart that'll blow your mind. Look at this. The National Association of Home Builders just released data showing that 74.9% of American households cannot afford a median-priced new home. That's 100.6 million households, nearly 3/4 of the entire country. Now here's where it gets crazy. While regular families got priced out, the stock market delivered 115% returns since 2020. But here's the kicker. The top 10% of Americans own 87% of all stocks. So while your stock-owning neighbors doubled their money, everyone else watched their dream of homeownership slip away. This is what economists call a wealth transfer, and it's the largest one in American history. Let me break down exactly how this happened because the numbers are absolutely staggering. But before I continue, I need to address something. A lot of people think this is just a housing bubble that's going to pop. They're wrong. And we'll show you exactly why in a minute using data that most real estate agents don't even know about. Right now, the median home costs $420,600. The median household income? $83,730. That's a price-to-income ratio of 5-to-1. Your parents and grandparents bought homes when that ratio was 2.6-to-1. Even in 1985, baby boomers enjoyed a 3.5-to-1 ratio. We've nearly doubled the affordability burden in just one generation. Here's what this means in real dollars. To afford today's median home, you need to earn between $100,000 and $117,000 annually. But fewer than half of American families make that much. And remember that first shocking statistic I mentioned? Here it is. First-time home buyers now make up just 21% of all purchases. That's the lowest percentage since they started tracking this data in 1981. The historical average? 40%. We've literally cut first-time buyers in half. But wait, it gets worse. The median age of a first-time home buyer just hit 40 years old. In 1981, it was 28. We're talking about a 12-year delay in home ownership. Do you know what that costs over a lifetime? The National Association of Realtors estimates it's $150,000 in lost equity. Now, some of you are thinking, but what about all those investors buying up houses? We're about to give you the real data on that in just a minute, and it's not what most people think. But first, let me show you the wealth explosion that's leaving everyone behind. Since 2020, Americans split into 2 completely different economic realities. If you owned a median-priced home and had $100,000 in index funds in January 2020, you gained roughly $280,000 in wealth by 2026. If you were a renter with no investments, you gained functionally nothing. In fact, you got poorer because your potential down payment lost purchasing power every month. Here's the breakdown of who owns what in America today. The top 1% holds 31% of total wealth. The bottom 50%? They own just 2.5%. For stocks specifically, the top 1% owns 50% of the entire market. That's worth $25.6 trillion. The bottom half of Americans collectively hold only 1% of stocks. Total U.S. household net worth just hit a record $176 trillion. But this wealth flows overwhelmingly to people who already owned assets before the boom started. Here's something that's going to shock you about wages versus corporate profits. And this explains exactly why your paycheck feels like it's shrinking while asset owners get richer. From January 2021 to July 2025, prices rose 22.7%. Your wages? They increased only 21.8%, if that. So, despite getting raises, you're actually 0.7% poorer than you were 4 years ago. But here's where it gets really ugly. Since March 2006, almost 20 years ago, nominal wages have risen 84.6%. Sounds good, right? Wrong. After adjusting for inflation, wages have increased only 13.8% over 2 decades. Meanwhile, corporate profits hit $4 trillion annually, more than double 2010 levels. After-tax corporate profits now represent 16.2% of national income, up from 13.9% in the 2010s. Where does all this money go? Research shows 76% of post-COVID profit growth flowed to dividends for shareholders. Workers got 9% through taxes. You got zero direct benefit. And remember that second shocking thing I mentioned at the beginning? Here it is. The income required to afford a typical home has increased 50% since 2020. 50%! Your wages grew only 27%. You're literally falling behind every month, and it's accelerating. Now, let me address the elephant in the room that everyone's talking about online. Are big corporations really buying up all the houses? The answer is going to surprise you. First, please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like, subscribe, and share helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. Here's what the data actually shows. Large institutional investors own less than 1% of all single-family homes nationwide. Blackstone owns about 3.8% of single-family rentals. And here's something most people don't know. BlackRock doesn't buy single-family homes at all directly anyway. People confuse them with Blackstone all the time. However, shout out to one of our viewers who stated he used to work for a billion-dollar equity firm and confirms 49% of their capital was going to a shell company under BlackRock being used to purchase a lot of single-family homes. In fact, major institutional landlords like Invitation Homes have been net sellers for 6 consecutive quarters. They're selling more homes than they're buying. But here's where it gets interesting. In specific markets, the picture changes dramatically. In top target metros, institutional ownership reaches 12.4% of rentals. Cities like Asheville see 30% investor ownership. Las Vegas and Memphis hit 26% each. And all investors combined, mostly small landlords, not big corporations, purchased 33% of single-family homes in 2025. That's a 5-year high. But here's the really troubling trend, and this ties into that third shocking revelation I promised you. Institutional capital has pivoted to something called build-to-rent. These are homes built specifically to never be sold to families. Build-to-rent completions hit an all-time record of 39,000 homes in 2024, 6 times the pre-pandemic rate. Blackstone's subsidiary is developing 58,000 homes exclusively for rental. This is capital that once built starter homes for families now permanently flowing into rental inventory. But why can't people just save up for down payments like previous generations did? The answer lies in data that most Americans have never seen. The personal savings rate sits at just 5.1% right now. From 1952 to 1990, it averaged 8 to 10%. At today's rate, the average household saves about $2,908 a year, if that. The typical down payment has more than doubled from $13,900 in 2019 to $30,400 today. At current savings rates, that requires 7 years of dedicated saving, assuming zero emergencies. But emergencies happen constantly. 59% of Americans cannot cover a $1,000 emergency from savings. 27% have zero emergency savings at all. Credit card debt just hit a record $1.23 trillion with average interest rates at 22.3%. Total household debt reached $18.59 trillion, up $4.24 trillion since before the pandemic. Here's the real trap. 50.3% of all renter households pay more than 30% of their income on housing. Among renters earning under $30,000 annually, 83% are cost-burdened with median residual income of just $250 a month after rent and utilities. These families cannot mathematically accumulate down payments regardless of how long they try to save. The generational data is where the story gets really heartbreaking, and it shows why this isn't temporary. It's a permanent shift in American society. Millennial homeownership stands at 54.9%. Gen Z adults have reached only 26.1%. At age 30, millennials hit just 33% home ownership. Baby boomers at the same age, 48%. That's a 15 percentage point disadvantage. And here's what's really devastating. 60% of Gen Z homeowners say they could not have purchased without financial support from family. 57% of millennial homeowners report the same thing. Family wealth has become the dividing line for homeownership in America. The share of young buyers with older cosigners is at the highest level in 30-plus years. Those first-time buyers who received inheritances of at least $5,000 were 7 times and 5.4 times more likely to become homeowners than those who didn't. But here's the really scary number. Forever renters have nearly doubled from 13% in 2018 to 25% of millennials today. 20% of Gen Z already describe themselves the same way. Nearly 2/3 of millennial renters who want to buy have no savings whatsoever toward a down payment. Now, let me show you the data that proves this isn't a bubble waiting to pop. This is a permanent restructuring of American wealth. The S&P 500 achieved 57 record-high closes in 2024 and delivered its best 2-year performance since the late 90s. Meanwhile, the University of Michigan consumer sentiment fell to 50.3, near the all-time low. We have record stock market performance with near-record pessimism about the future. That's because asset owners experience appreciation as economic optimism, while everyone else experiences stagnant wages and unaffordable housing. The housing shortage compounds everything. We need 3.7 to 7.1 million additional units depending on methodology. New construction can't keep pace because restrictive zoning limits 60% of residential land in major metros to 2 to 3 stories. And here's the lock-in effect. 80% of millennial homeowners have a sub-5% mortgages and won't sell, further restricting supply. Mortgage rates dropped to 2.65% in early 2021, fueling the price surge, then spiked to 8% before settling at around 6% today. Every 1% rate increase reduces purchasing power by 10%. Buyers who qualified for $500,000 mortgages at 3% can only afford $350,000 at 6%. Monthly mortgage payments for a median home have roughly doubled since 2019. The typical household would need to spend 44.6% of income on housing versus the recommended 30% maximum. If home prices had grown at the same rate as inflation since 1970, the median home would cost $177,788 rather than today's $408,000. Federal Reserve Chair Jerome Powell acknowledged in December that housing will be a problem, but noted that monetary policy alone can't solve regulatory costs and housing shortages. This isn't a temporary condition awaiting a market correction. We're witnessing a structural transformation. From family homes to institutional assets, from starter home construction to build to rent, from broad-based wealth building to concentrated asset ownership. For the 25% of millennials who now expect to rent forever, for first-time buyers whose median age has reached 40, and for the 100 million households mathematically excluded from home ownership, the American dream of ownership has become exactly that, a dream rather than an achievable reality. The data shows that 74.9% of American households cannot afford a median-priced new home. This represents the largest wealth transfer in American history, and it's accelerating. The housing market hasn't just become expensive, it has fundamentally broken for the majority of Americans. And the structural forces driving this transformation show no signs of reversing. If you found this data as shocking as we did, make sure to subscribe for more real estate market analysis. And let us know in the comments, are you seeing these affordability challenges in your local market? We read every comment and sometimes feature viewer questions in future videos. Thanks for watching, and I'll see you in the next one.